Welcome to the Deep Dive. Today, we're digging into China's latest economic performance. This is for May 2025.
Yeah, we've got quite a bit to sift through. Official stats, China briefing, real logistics.
Right, Ministry of Commerce insights, too, plus Carnegie China and even some Reddit discussion.
A real mix.
So our mission really is to pull out the key takeaways for you. Figure out how China's handling things, the headwinds, global trade, and, what it means. Let's unpack this.
Okay. Well, it's fascinating how sentiment shifts, isn't it?
Yeah.
Early 2025, those GDP forecasts. Pretty cautious.
Below 5% mostly, yeah. I remember HSBC sitting around 4.2, 4.5%.
Exactly. But then you had those government announcements in March, and boom, revisions upwards,
Yeah.
4.7, 4.8%.
But it didn't stop there. Mid-April hits, new U.S. tariffs.
And things got shaky again. UBS, I think, forecasted as low as 3.4%. Big drop.
Wow. But then another twist, that May 12th U.S.-China statement.
Right. And suddenly banks are revising up again. Some by, half a percentage point?
It's a real roller coaster. And Carnegie China adds a critical layer here, doesn't it, about the 5% target?
Oh, absolutely. They stress it's mainly a policy directive, not just a forecast.
Meaning the government steps in to make it happen?
Pretty much. Through state intervention, soft budget constraints is the term they use. Basically, financial backing for enterprises.
So the quality of growth might change, maybe more consumption, less debt-fueled investment, but the number itself.
It's likely to be hit, yeah.
Right.
We should probably expect China to land somewhere in that 4.8 to 5.0% range by Q4.
Okay. And thinking bigger picture, this impacts global ocean freight, right? Keeps demand up, but maybe shifts where it's going.
Definitely. It creates these differentiated flows, puts pressure on capacity, rates, especially with things like the Red Sea tension still playing out.
So let's look at the May data itself. It sounds like a mixed picture. Resilience, but also challenges.
That's a good way to put it. On the resilient side, you've got domestic consumption holding up. Retail sales had their best month since December 23.
Those trade-in incentives helping there?
Seems like it. And the services sector looks robust too, especially information tech services, up significantly.
And the high-tech focus is clear.
Very clear. Big jumps in things like 3D printing, industrial robots, and FDI is following that trend, pouring into high-tech areas, e-commerce services, aerospace. Huge growth there.
Plus the trade diversification, that's a big story. Exports to the U.S. down.
Predictably, with the tariffs.
But then exports to ASEAN shot up, and the EU too?
Yeah, ASEAN up over 10%, EU up around 3%. It shows real strategic adaptation, shifting focus.
Okay, but it's not all smooth sailing. What are the headwinds?
Well, industrial output growth slowed. Its slowest pace since last November, actually.
Oof. And FDI. You mentioned high-tech growth, but overall?
That's the catch. The number of new foreign firms increased, yes, but the actual amount of foreign capital used? That declined, noticeably, down 13.2% January to May.
That does raise questions on demand, doesn't it? And deflation.
Still a pressure point. The CPI, Consumer Price Index, fell slightly year on year. Just demand is still, a bit weak.
And the trade tensions haven't vanished either, despite that May statement.
Not entirely. China suspended some additional duties, sure, but key retaliatory tariffs, like on U.S. agriculture, still there.
And China's Ministry of Commerce is saying?
They're open to talks, but they want sincerity from the U.S. side, meaning reversal of those unilateral tariffs.
Plus, European businesses are feeling hesitant.
According to their chamber survey, yes, deepening hesitation about committing capital. Fewer are ranking China as a top investment spot right now.
It really is complex, resilience, adaptation, but also these persistent challenges. So after hearing all this, what stands out to you listening? Is it the adaptation that shines through, or are the challenges more worrying? We'd love to hear your take.
And the reasons behind these trends, they seem pretty clear, actually.
Policy playing a big role.
Definitely. Fiscal nudges, those retail incentives, all aimed at boosting domestic demand to stabilize things.
And the U.S. trade decline is directly linked to the tariffs, forcing that diversification we talked about.
Exactly. China has to pivot, build resilience, reduce reliance. You see it in things like semiconductor imports from the U.S. dropping. They're trying to make more domestically.
And back to Carnegie's point, the government directing investment when needed to hit that GDP target.
Right. Infrastructure, manufacturing. Plugging the gaps. It's state-guided growth.
And this whole tariff situation is just an ongoing negotiation, a diplomatic dance.
Pretty much. China's signaling they need broader tariff removal for real progress, even with those May tweaks.
Okay, so wrapping this up, What's the overall conclusion from these different viewpoints?
I think it's clear China's economy is rebalancing, shifting towards consumption, innovation, adapting to the outside pressures.
And while overall FDI inflow is down, that shift towards high-tech investment is significant. A change in quality, maybe?
Potentially, yes. Signals a focus shift. Trade tensions obviously continue to bite, especially with the U.S.
But the diversification efforts show resilience. So the outlook is mixed, but maybe cautiously optimistic.
I'd say so. Cautious optimism seems fair. They're using domestic levers and targeted upgrades to navigate the global uncertainty.
So this deep dive really highlights it's less about the quantity of China's growth in 2025 that seems somewhat steered by policy and more about its composition, its quality.
Exactly.
Which leads to a final thought for you. How might the strategic pivot by China towards domestic consumption, high-tech self-reliance, all while navigating trade talks, how might that reshape global supply chains and economic ties in the coming years?
That's the big question. We'd love to hear your thoughts on that. What insights did you gain? Let us know on our website.